This is Horizon's Middle East and Africa, our top stories this morning. Asian equities seeing modest gains while futures drift lower after U.S. jobs data does little to boost bets on further Fed rate cuts. Focus now turns to Thursday's CPI figures. Oil jumping on supply concerns after U.S. President Donald Trump orders a complete blockade of tankers going into and leaving Venezuela. Plus, Bloomberg learns Warner Brothers is planning to reject Paramount's hostile takeover bid due to concerns about financing and other terms. It's just gone past 9 a.m. across the Emirates, 7 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi, and plenty for markets still to dissect and digest after we did get that delayed U.S. jobs report on Tuesday. Though, as we were just mentioning at the top there, doing little to change investors' tone about potentially what we're seeing for the path ahead for monetary policy. And if you take a look at where U.S. equity futures are, not doing so much at this point in time. We're seeing U.S. equity futures, S&P futures, they're edging lower after a third straight day of closing in the red. S&P futures, as well as most of the indices closing in the red after that delayed U.S. jobs report. And really what we're trying to get to the heart of is what that jobs report changed about the path ahead and the trajectory that markets anticipate for monetary policy and the Federal Reserve. Right now, markets still pricing in roughly about 20% chance of a January reduction after that last reduction that we saw last week. And as we mentioned just there at the top, focus now is turning to those inflation numbers that we will get from the U.S. on Thursday. But also, if we cross the Atlantic, we're also waiting for U.K. inflation numbers ahead of the BOE decision. So that's also something we're watching closely ahead. We have the U.S. 10-year yield edging up ever so slightly right now at 416.85. We mentioned one of our top stories today is, of course, what we're paying close attention to, those escalating tensions between Venezuela and the U.S. Brent crude up now just over 1.3% after losing more than 5% in the previous 5 sessions, actually sending crude higher from its lows since 2021. And we have silver on the board. Again, silver is going quite high, up more than 3.3%. Some of that is the escalating tensions, the geopolitical tensions we're seeing more broadly, having an effect on safe haven bids and also precious metals more broadly. We're seeing gold also up, but silver hitting a record high, trading there at about $65 there. Let's just bring you our terminal chart there, which is zeroing in on more of some of that data that we got from the U.S. on Tuesday. U.S. payrolls a bit volatile as November did see a recovery from October's really disappointing carnage, of course, that we're trying to dissect as we got a bit of the government shutdown figures factored in there. The unemployment rate, though, in the U.S. still remains stubbornly high, but still far from any panic levels. And in short, it really gives both the hawks and the doves branches to stand on. And we are hearing quite a bit of Fed commentary since that FOMC decision last week about where each of them stand and why they made the decision that they did. Let's zoom in, though, on how markets in Asia are faring on this Wednesday. Min Min Lo is standing by in our Hong Kong studio. Min Min, what are you watching?
Hey Jen, one stock to tell you about, MetaX debuting in Shanghai's Star Market today, and look at this number, an eye-popping 680% gain on its debut here. Remember more threads just over a week ago, we saw up to a 500% gain on day one of its trading, and MetaX really outdoing that stock debut there. And this is another chip startup started by someone who worked for AMD for 14 years. He left AMD 5 years ago to focus on this startup, a company that designs and sells GPUs for general computing purposes, for AI inferencing, for graphic rendering as well, and certainly a lot of retail interest here for the domestic substitution theme in China. And of course, one uncertainty is now that the H200 chips from NVIDIA has gotten approval from the Trump administration to be sold in China, the Chinese government so far have not yet given a clear guidance as to whether or not they would allow Chinese companies to buy them, but still a lot of interest in this Meta X, something that we'll keep an eye on. But you flip the board and take a look at some of the small cap stocks in China, because we had seen a tech sell-off in the US, concerns around overextended valuations, about high capex spending, and in China too, we're seeing that to a lesser extent, and we are seeing, for example, the China-X really doing very well today, the Star Index, Star Market as well. These are sort of the second-tier tech stocks that are listed in China. People are now diversifying away from the big names like Alibaba and Baidu, and the Meta X story really plays into that as well. We're watching the Hang Seng China Index as well as the MXCN. These are the two indexes that briefly touched correction territory yesterday during intraday trading, but we are rebounding from the lows of yesterday, now up about 1/10 or 0.2%, but there continues to be concern around the growth momentum in China as we head towards the year end.
Thanks so much, Min Min Lo there in Hong Kong. Min Min, we'll check back in with you in just a bit. Let's stick with the markets, though. U.S. job growth remained sluggish in November, and the unemployment rate rose to a 4-year high, pointing to continued cooling in the labor market after a weak October. While the data comes with caveats, the report will help inform investors' expectations for the path of interest rates next year. For more insight, let's bring in Selena Ling, OCBC Chief Economist and Head of Global Markets Research and Strategy, who is joining us from Singapore. Selena, great to have you on the show. Thanks so much for being here. So let's just start here. Your base case was for just one cut in 2026. I wonder if this softer print that we did get on Tuesday reinforces your expectation for the path ahead for monetary policy.
I think the Bloomberg chart that you showed earlier is very telling, because we've got a lot of volatility on the non-farm payroll numbers month on month, especially due to the US government shutdown. But what is really undisputed really is that unemployment rate is actually picking up. And I think the Fed is going to really zoom in on that. I think going ahead, although there are still some concerns that inflation may actually pop a little bit higher come 2026, but generally, the pause may not last too long. We do have a base case for another 25 basis point cut in first quarter of next year. If they do pause, then I think it's important to see, of course, Thursday's CPI number and also the months down the road. But I think if the Fed were to choose between potential inflation down the road and the current cooling in the labor market, my suspicion is that they will be biased towards, buying more insurance on the rate cut side.
Let's just stick on that, Selena, because we are getting quite a bit of Fed commentary right now, where there is a bit of dichotomy, really, between whether or not the focus is on the labor market or price pressures. What do you see as the most pressing risk right now in 2026?
I think the concern really is that if the softness in the labor market actually precedes a softening in terms of private consumption, then one of the key growth pillars that has been supporting the US economy will actually be coming into play in 2026. So the slowdown story in 2026 for the US economy currently assumes that it's going to be a very gradual soft landing. So I think if there are any signals that it's going to be anything other than a soft landing, then I think the Fed is going to be concerned. And I still think that we do have to also watch out for some of the changes in the Fed board governor composition. Given that Fed Chair Powell, term will end by May, and currently we do see a small majority of the officials leaning towards the dovish side. That said, market expectations are very dovish already compared to the Fed's dot plot. So anytime we get a better than expected data surprise, I would not be thrown off guard that we do have some swings on both ways. The balance really is two-sided risk from here. Every time we get a new print on the data front, whether it's on the inflation or labor market, market will just readjust. We are data dependent.
Let's just turn then, Selena, to some of the fluctuations that we're seeing in the currency market, especially with dollar yen ahead of that BOJ decision. I wonder when you look into some of the back and forth that we're seeing, what do you see continued downside for the dollar? If we take a look right now at the pair, it's at about 155. What is your short-term expectation for how this dynamic plays out?
So our base case really has been that the BOJ would hike at the next meeting. And what underpins this expectation really is that wage growth, we think, should be sustained. So a lot of that pullback in terms of BOJ rate hike expectations was really, in terms of the change in leadership and, of course, the China-Japan spat recently. But I think that has really very much normalized to a large extent. So I think markets will go back to focusing on the fundamentals. And the fundamentals really are that the BOJ still probably will hike from here, even coming from a very low base. And the Fed is likely to cut from here. So I think the interest rate differential, should continue to narrow. And we think that that should lend some support to the Japanese yen in the near term.
So you believe potentially we'll see some dollar weakness heading into 26?
I think it's possible, but that's it. Of course, we are coming into the holiday season, so liquidity is, of course, thinning out. And I think, a lot of the traders, for instance, should be taking a breather fairly soon.
I'd like to finish, Selena, on some China policy. We have a story on the Bloomberg terminal that talks about some of the debate right now about Chinese economists and central bank officials about whether or not a stronger currency is needed to support the economy. What would your response be?
Well, since April, actually, if you look at the fixing, that has been quite consistent. The PBOC looks like they are guiding for the renminbi to appreciate on a very gradual path. So far, we've not had any strong indications that they're going to deviate from this guidance. Of course, the pace of the appreciation may, be tweaked and adjusted as time goes by. But generally, we look at the whole headline growth for China. They are likely to come in very close to their 5% growth target for this year. And I think in this period of continued volatility, now that the trade deal has been more or less kind of settled with the US, I think their preference would still be one of a very stable, gradual, incremental appreciation of the renminbi against the dollar. So I don't expect that this would really shift in the near term. But of course, we have seen that the US administration can be quite fickle sometimes. So, as the headline news breaks, it may change.
That's it. That was a kind way to say it. Selena Ling from OCBC joining us there in Singapore. Selena, thank you so much for your insights this morning. Great to have you. Now, coming up, sticking on the U.S. administration, President Trump says he's ordering a blockade of sanctioned oil tankers going into and leaving Venezuela. We have more on the escalating tensions next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zapasaja in Johannesburg. U.S. President Donald Trump is ordering a complete blockade of sanctioned oil tankers moving in and out of Venezuela. The move increases pressure on Caracas amid a U.S. military buildup in the region. Joining me now is Nicholas Lua, Bloomberg's oil reporter, joining us from Singapore. So, Nicholas, quite a vehemently worded tweet or post from President Trump. Why exactly is Trump blockading Venezuela?
So the rhetoric's an escalation of what he's already accused the Maduro administration of, basically accusing them of drug crimes. But I think what's important to recognize, Jen, is how this is a major escalation, right? A blockade of crude carriers is following what was previously already much hostile acts of aggression towards Venezuela. Trump has previously seized a tanker off the coast of Venezuela. And I think what this also means is we're seeing all those who have not much to cheer about are having something of an early Christmas present as a result.
For some people, but if we take a look at where we're seeing oil prices right now, Nicholas, what exactly would this blockade and, in fact, an escalating of tensions mean for where prices go from here?
I think in terms of the short term, like today, like all those are clearly taking some profits here. We've seen oil spike about WTI went up over 1.5% earlier today. It then paired some gains, but it's back in territories around the 1.5 range. So I think what this is saying is that in a market where the oversupply narrative is so strong, we are seeing some support here on this headline that's geopolitically driven. But from a fundamentals perspective, Jen, and let's be real here, Venezuela, even as it is an oil exporting country, is not a major player on the global stage, right? It's less than 1% of global oil exports. And so as a result, even as we're seeing this blip come up and give some support to oil markets, I don't expect this to be a long-term thing that's going to persist. We're still headed into a glut. Just yesterday, need I remind the markets, Brent dipped below 60 for the first time in over half a year. So yeah, the direction is still down, even as geopolitics gives us some little support and blips up.
Do you anticipate then more volatility than Nicholas moving forward?
I will say that Trump is very unpredictable, as we all know, and I think even as some people were expecting quiet heading into the Christmas year-end season, he's already upended expectations for that with this latest blockade, this latest escalation. So I will say, I think as a result, we need to be on watch, and yeah, it does look like more is to come.
Nicholas Lua, Bloomberg's oil reporter, joining us there on Venezuela. Nicholas, thanks so much for your report. Now, coming up, we switch gears. Tesla sales in California could be halted for a month unless the company alters how it markets its autopilot technology. We'll bring you that story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Tesla's shares paired some declines after the bell amid news that its sales in California are poised to be suspended for 30 days. That's if it doesn't change its marketing practices that allegedly misled consumers about its driver assistance technology. Before the news, Tesla shares traded close to near record highs on rising optimism about the company's self-driving and robotics efforts. Let's bring in Bloomberg transport reporter Danny Lee, who's joining us from Hong Kong. Danny, what are these specific issues that Tesla is facing here in California? This is clearly not something that the company wants to be dealing with right now.
Hey, Jane, good morning. So Tesla does indeed face a 30-day suspension on sales in California, its biggest market in sales in America. And really it revolves around the California Department of Motor Vehicle taking issue with Tesla over its marketing description of stuff like full self-driving and autopilot. You know, the marketing around that and how its capabilities are advertised to the consumer. Right now, though, the suspension won't go into effect for 90 days, and that does give Tesla the time to respond and make its next move, particularly if it decides to comply, although it could appeal this ruling. Now, as you said, the shares in Tesla in post-market trading slipped 2.2%. And then pulled back on those losses as well. But as you see in pre-market trading, Tesla's shares are back in the green. However, it did close yesterday on Wall Street at record highs, now worth $1.63 trillion. And that has been fueled by investor sentiment around Tesla's full self, its auto-driving capabilities, its robotics. So there is that momentum, and it really does contrast with how the EV business of Tesla, its core business, is still struggling. And given what has happened in the likes of Europe with its ruling on rolling back its combustion engine ban, it really does put Tesla firmly a bit under pressure.
Yeah, and Danny, let's just contrast that story with what is happening in Europe, because this was quite surprising news that Europe was pulling back on this ban on combustion engine cars after being so adamant about trying to push this forward. How much does this help potentially Europe's struggling automakers? And potentially, are we going to see some of those ICE cars and automakers being the winners here?
Yeah, I think the devil is really in the detail, because when you unpack this ruling, whilst this ban doesn't take effect in 2035 around phasing out gasoline, gas-guzzling cars, there is still this pressure on automakers to reduce tailpipe emissions, not by 100% by 2035, but at least by 90%. So there is still stringent conditions that they will need to meet in terms of their emission standards. And so what this ruling does allow is flexibility around some of the cars that will be able to exist into the middle of the next decade, such as these so-called EREVs, these extended range electric vehicles, which are powered by the gasoline and help charging up the battery. So there is some winners there, but clearly there are some losers. Perhaps the Chinese EV makers, but we shall see.
Bloomberg's Danny Lee, always great to have you. Thanks so much, Danny, for that report. Appreciate it. Now, JetBlue's CEO has told us the company expects to see the benefits in sales and cost efforts next year. Speaking exclusively to Bloomberg TV, Joanna Garrity says JetBlue has a lot of bookings coming in for the holiday season.
2025 has been a very tough year, whether it was the macro setback or the government shutdown or the list goes on and on. We're really looking forward to the holiday season. Bookings are coming in strong. As we go into 2026, we're optimistic that the consumer is healthy and that we're going to start really ramping up the initiatives that we have been working really hard for the last year to execute to and seeing the benefit as we move through 2026.
How long do you think it'll take before you start to actually turn profitable and sustain that?
Our goal next year is to break even from an operating margin perspective, and that's the first step back to profitability. We have a great team here. Everybody's pulling for us. We're doing all the right things, whether it's our focus on operational reliability, net promoter score, all of the premium products that we're launching, our laser focus on costs, and really trying to make sure that we're delivering a great product offering for customers, because JetBlue has this wonderful brand and this sense of people want to love us and they want to see us succeed. And 2026 is going to be our year with everything we've put into place.
Because 2025 was not the year for a lot of airlines. There were a lot of issues. And you talk about the government shutdown. This has been a big discussion among a lot of the airline CEOs where they've said we just can't make up that kind of revenue. So there will be some sort of hit. Have you disclosed any kind of revenue loss as a result of some of the shutdown?
We haven't disclosed any kind of revenue loss. We've said that we remain on track for Q4, and I think we're pleased with what we're seeing in terms of bookings coming in for the balance of the month. We definitely saw some softness, obviously, during the government shutdown, but we're recovering coming out of that. I think most have shared that, but it was definitely an impact, and unfortunate that the airlines were put, right in the middle of that shutdown. All the great air traffic controllers and the TSA workers, they need to be, cast as essential workers. We really need to make sure that, if anything, this industry is so essential to our economy. Think about all the people who were traveling for weddings and funerals or doctor's appointments that were displaced because we couldn't get on the same page in Washington, D.C. So we're really hopeful that, we've turned a page there and that we can move forward, looking at that end of January date with, a little bit of nervousness, but I'm confident that D.C. will pull it together and get us in the back end of that.
Yeah, you somehow, being an airline CEO probably wasn't in your bingo card that you'd be well focused on healthcare legislation with your fingers crossed heading into January. I'm wondering how much you're hoping to attract a new class of customers versus capitalize on the ones that you have that might be willing and able to pay a little bit more with some of the new offerings.
Yeah, it's a little bit of both. We know we have customers today that want our first-class product, and so it's really, offering that to them so that they can buy up when that opportunity presents it. But it's also making sure that we're competitive with the industry. Everybody's moved towards premium.
This is Horizons Middle East and Africa, our top stories this morning. Asian equities seeing modest gains while futures drift lower after U.S. jobs data does little to boost bets on further Fed rate cuts. Focus now turns to Thursday's CPI figures. Oil jumping on supply concerns after U.S. President Donald Trump orders a complete blockade of tankers going into and leaving Venezuela. Plus, Bloomberg learns Warner Brothers is planning to reject Paramount's hostile takeover bid due to concerns about financing and other terms. It's just gone past 9:30 a.m. across the Emirates, 7:30 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersetchi, and we did get a bit of sluggish numbers from the U.S., from those delayed numbers from the U.S. Jobs data on Tuesday. And what we're seeing right now with S&P futures edging lower ever so slightly after a third straight day of losses closing in the red after that delayed U.S. jobs report. Markets now, after that data print that we did get on Tuesday, pricing in about a 20% chance of a January rate cut from the Fed. Focus, as we were just mentioning there, is turning now to the CPI figures that we will get on Thursday from the U.S., but also today, worth paying attention to what we get from the U.K. because inflation data will be coming out ahead of that BOE decision that we're anticipating. The U.S. 10-year yield right now inching up ever so slightly, right now at 4.1685 there. Of course, we're watching closely how some of this rhetoric around where we see the FOMC committee, how they made their decision last week is affecting the bond market more broadly. Brent crude, as we mentioned, escalating tensions feeding into the energy sector right now. Brent crude up just over 1.4% there to trade at about $59.77 a barrel there. We're seeing crude going higher from its lows from 2021 after losing about more than 5% from its previous 5 sessions. And we also have silver on the board. Some of those geopolitical tensions feeding into some safe haven demand. We are seeing gold up strongly today, as well as silver up more than 3.8%. Gold has actually surged more than 60% this year, and silver has more than doubled. So paying close attention to where we see precious metals going. Silver, spot silver right now is about $66.20 an ounce there. Let's zoom in, though, on our terminal chart this morning, and it zooms into some more of that data that we did get on Tuesday. Part of it was around some of the U.S. payrolls that were quite volatile in November, but we did see a recovery from October's carnage. The unemployment rate, though, still remains quite high, as we've been talking to our guest about all morning, but still, as you can see from this chart there, far from panic levels. Still trying to dissect where we see the committee moving from here and whether or not the doves or the hawks win out in this current debate that's going on right now. Let's zoom in, though, on how markets in Asia are faring. Min Min Lo is in our Hong Kong studio with more. Min Min, what are you watching?
Hey, we are digesting some of the macro data from Japan today because the export numbers dropped and we saw a 6.1% gain on exports, the third consecutive month of gain. And this is really being led by an increase in exports to the U.S. for the first time in 8 months. So this is boding very well for the upcoming BOJ rate decision on Friday, widely expected to be a hike. We are also watching the inflation data due on Friday as well. But overall, we know inflation has been above the 2% target for about almost, I think, 3.5 years now. And as we take stock of the year and look at how Japanese stocks have been doing, we notice that value stocks actually have been beating growth stocks for a few years now. It's been tracking very closely to the higher inflation and interest rates as well, because higher inflation obviously allows some of these mature industries, low growth industries, to boost prices. So they are once again set to beat the growth stocks this year. This trend expected to continue into next year as well. We're watching the yen and we are seeing it weaken about 0.2%, now flipping up again above the 155 level right now as we look towards the BOJ rate meeting.
Yeah, nice to get a look at that before that meeting. Min Min Lo in Hong Kong for us. Min Min, thanks so much for walking us through all of that. Now let's get back to one of our top stories today. Oil is advancing from its lowest level since 2021 after President Donald Trump ordered a blockade of sanctioned tankers off Venezuela. Joining us to dissect this a bit more is Rachel Ziemba, founder of Ziemba Insights. Rachel, thank you so much for being with us. We were speaking with our oil reporter earlier about this situation, and he was noting that Venezuela is not necessarily a major player in the oil markets. But what, if any, impact could this incident have on the current oil market?
Sure. So I think he's spot on. This is less than 1%. Venezuela's production is less than 1% of global production. What I think it would do is have more effect on other sanctioned supplies. For example, the Russian supplies, the Iranian supplies. There's a lot of competition among these three countries that use the same illicit tankers and financial channels. They have the same primary buyer, which is China, and the like. What we've already seen with the tanker seizure from last week is that reinforced what has been an increase in cost of tankers, especially those who will engage in shadow fleet dynamics but are not yet sanctioned. What I note also, though, is that this blockade provides a loophole for Chevron for the supplies going to the United States because they don't use sanctioned tankers. So we'll see how it plays out. I'm watching in particular also whether at the same time the U.S. is willing to tighten the screws on Venezuela and on Russia. If so, then we might see more of a market impact. But as you can tell, I'm a little bit skeptical of the Trump administration willingness to really enforce their Russian sanctions.
Sure. And Rachel, just on that point, we have over the past few weeks and months still seen oil trading in this very narrow range. Would it be potentially additional sanctions on Russia that would make a significant impact or break a break outside of this range that we're seeing here? What do you think?
Yeah, I think we might need to see that or a significant increase in demand, right? Demand has been relatively sluggish this year, and we've seen enough supply increase from non-sanctioned OPEC plus countries, right? Particularly those in the Gulf, taking back market share, including from some of these countries. So we could have the supply shock or the demand shock. But, you know, the fact that we are talking about tanker seizures, tanker explosions, higher shipping costs at a time when oil prices are in the mid 50s, this is a different dynamic, and that reflects the relatively ample and well-supplied markets. Also really key here, does China continue to buy and build its stockpiles when oil prices are cheap? My hunch is they will. That will provide some floor here. And that's one of the reasons why I don't expect oil prices to go, if they get below the $50 mark, I don't expect them to stay there.
You don't expect? That's what I was going to ask. I mean, what would have to change if we do, in fact, see China buying more and, in fact, injecting some of that stoppage to that $50 floor that you're saying?
That's right, Jennifer. I think we would have to see, China, as I say, China making different decisions. If we see if we really see demand weakness, OPEC Plus already decided they're not going to keep adding in the first quarter, but this has been a bit of an ample, an increase. That's an important dynamic. The other thing, of course, we're watching is this new supply out of the Americas, including Venezuela's neighbor, Guyana, and the resilience, in a way, of U.S. production. I do expect as we go into next year that the relatively low oil price environment is going to lead to some slackening of U.S. production as new investments are not occurring.
Rachel, I'd love to just finish on natural gas because you actually believe that natural gas is better supported than oil right now. I wonder if that's a short-term story because just last week we were talking about potentially milder winter weather being a different story than what we're hearing right now.
Yeah, I think that's right. And there are different timeframes we're all dealing with here. Sitting here on the East Coast of the U.S., I hope that it's going to be a milder winter because it's been a pretty cold start to it. But it's not all about me. So look, I think right now we are seeing a dynamic where Europe, in phasing out Russian gas, is the buyer of last resort for LNG, especially U.S. LNG. And we're seeing Qatar wait and see about signing new contracts. So I do expect 2026 with AI-related power demand, with data center demand, that will support natural gas prices, maybe not as quite as strong as 2025. But then as we go further out past 2027, there's a lot of natural gas coming on the market. And there's a lot of countries that are saying, we're not going to buy unless prices go into the high single digits or mid single digits. So there's going to be a bit of a price war ahead with some volatility and interesting trading dynamics ahead.
Right. I did see some of those pictures from New York over the weekend, so it does look quite cold. Hopefully you're staying warm, though. Rachel Ziemba, founder of Ziemba Insights. Rachel, thanks so much. It's always great to have you. Appreciate your insights. Now, let's switch gears a bit. Jared Kushner's Affinity Partners is exiting from Paramount Skydance's hostile bid for Warner Brothers. The move comes as Warner Brothers plans to reject Paramount's offer in favor of its deal with Netflix. For the latest, let's bring in Bloomberg's deals reporter, Manuel Bagori. Manuel, what ultimately drove Kushner's Affinity Partners to walk away? This is playing out a bit like a movie script.
Yeah, definitely a good movie to watch. Maybe a Netflix show, who knows? But yes, the saga continues, and the next steps might be, or the next episodes might be coming out very soon as today, Wednesday. We expect Warner Brothers to potentially urge shareholders to reject the proposal made, or the hostile bid made by Paramount. We saw the latest developments also, as you rightly pointed out, with Jared Kushner's withdrawing as one of the backers to Paramount's offer. There is, according to our sources, concerns from Warner Brothers around the financing and terms offered by Paramount's offer. They still believe, according to our sources, that the offer made by Netflix is superior and also offers more warranties in order to get the deal completed. So definitely a super interesting saga, and next steps to be seen soon.
What are the next steps, Manuel, in the takeover battle?
Well, definitely we'll see potentially the response from Warner Brothers as soon as today, urging shareholders to reject Paramount's offer. And then it will be seen whether or not Paramount goes ahead with the hostile bid. They could also withdraw it. There could also be new potential steps from Netflix or from Paramount itself. But I think the next step should be one in which we see Warner Brothers saying something more formally or publicly, telling their shareholders to reject Paramount's offer. And then we'll see how Paramount counterattacks or reacts to that statement, whether they go ahead in a hostile way, whether they withdraw their bid, or whether any other remedies or tweaks are made to the offer to make it more compelling. It will be interesting to see what happens after Jared Kushner is withdrawing their support to the bid as well.
Right. It's a fascinating story there. Bloomberg's Manuel Bagori. Manuel, thanks so much for walking us through the latest with that story. Now, coming up, South African banking giant Capitec is one of Bloomberg Intelligence's top 50 stocks to watch in 2026. More on what's behind its success next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, let's turn to South Africa's biggest bank by customer base, Capitec. It's one of Bloomberg Intelligence's top 50 companies to watch in 2026. BI says the lender is on track to generate earnings growth of 15% or more through to 2028. That's as Capitec takes its low-cost, low-price business model developed for consumers and applies it to business banking, insurance, and mortgages. Earlier this year, I traveled to the company's headquarters to look at what's behind its growth.
Much of Capitec's success is due to its relentless focus on banking the so-called unbanked. During apartheid, Black South Africans were excluded from formal banking. Even well into the 90s, lenders were slow to offer services to these people. Those living in informal settlements who, bank executives believed, had no interest in opening or maintaining a bank account. Capitec has been the Johannesburg Stock Exchange's best-performing company since 1994, beating the next best three combined. Its market value exceeds that of Africa's #1 lender by assets, Standard Bank. While competitors have significant interests abroad, Capitec remains primarily focused on South Africa, where it's now branching out into all kinds of credit offerings, insurance, and a host of digital services. But the new CEO, Graham Lee, insists little will change. Having run the company's retail unit since 2022, he's promising continuity.
I think there's a lot of ways in which I'm very similar to Gary, in which we think quite similarly about strategies, about culture, about the importance of the various different groups of people within Capitec and how important that humanness is to achieving our goals in a world where it's becoming more and more digital with our competitors.
And it's not just Capitec. Many of its competitors have recently seen leadership changes. FirstRand, Nedbank, Investec, and now ABSA all have new bosses. The sector has been on its toes as African banking faces continuing headwinds, challenges the new CEO says he's ready for.
There are global uncertainties, which certainly don't make the job any easier. Despite that, I do feel cautiously positive. And the reason for that, I think that in terms of our operations and our strategy, we are well positioned to thrive despite those challenges.
And for more stories like this from the continent, catch our TV show Next Africa, airing this Friday on Bloomberg Television, on the terminal, and of course on the website. Now, let's dig into some of the other stories we are following today. The African Development Bank has secured a record $11 billion in new funding for its concessional lending arm. The replenishment drew contributions from 19 African nations for the first time, along with major pledges from the OPEC Fund and the Arab Bank for Economic Development in Africa. The funding will support projects including expanding access to energy, strengthening food systems, and building resilient infrastructure. Mozambique has signed a memorandum of understanding to receive $1.8 billion from the U.S. over the next 5 years. The funding, part of Washington's America First health strategy, will be used to provide HIV prevention drugs and drive advancements in malaria efforts. 4 other African countries have signed similar agreements so far, including Kenya, Uganda, Rwanda, and Liberia. And the Rwanda-backed M23 rebel group says it will withdraw from the eastern Congolese city of Uvira under pressure from the United States. U.S. officials say the rebels seized the city earlier this month alongside Rwandan troops, though Rwanda denies supporting the group. M23 says the pullback is meant to give the Doha peace process the maximum chance to succeed. And coming up, we switch gears. iRobot co-founder Helen Greiner shares what led the Roomba maker to bankruptcy and why the U.S. lost its edge in robotics. Stick with us. This is Bloomberg. Earlier this week, iRobot, the company behind the Roomba robot vacuum, filed for Chapter 11 bankruptcy and proposed handing over control to its main Chinese supplier. We spoke with Helen Greiner, the co-founder of iRobot, about how the company she helped build reached this moment and how the global robotics landscape has evolved.
we always thought it was inevitable. Like what we learned very early on is that the low-cost labor doesn't exist here. The very skilled and intricate construction isn't here. I mean, there's lines of mostly women building Roombas in China and Vietnam. And also, you don't have the supply chain here. That it really hasn't set up for manufacturing. There's a price point at which you can manufacture in this country. A car, I know Whirlpool does some washing machines here, but it's extremely, extremely difficult. And don't let anybody tell you otherwise. We certainly would have wanted to manufacture in the United States. And as the value of the robots go up and the costs, what people are willing to pay for them go up, I think they can be manufactured in the United States. But it certainly wasn't possible for these low-cost consumer products or things like high-end toys. It's something that it's just not possible.
Well, that is part of the motivation of President Trump's tariffs, is to bring that manufacturing back to the United States. Do you feel that it's going to make a difference for companies, well, maybe too late for iRobot, for other companies that were potentially facing the same situation?
I think it will be hard to get a low-cost consumer product manufactured in this country.
How would you characterize the current state of competition between the U.S. and China in the robotics space? Do you feel like any one country is leading? Where's most of the innovation happening now?
Well, that's the issue. We were leading. Roomba, iRobot proved that you could have a business around robots. And believe me, when we started in 1990, that was not at all, certainly the case. But we did it. We succeeded. Dream come true. And now it's really, iRobot, the assets are going to a Chinese company. Chinese companies are independently succeeding in this in this field. And everybody's all crazy about humanoids right now. The humanoids coming out of China are, I think, as good as the ones here, but also at a lower price point because they're concentrating on manufacturing efficiency as well. Now, I don't believe we should just be concentrating on humanoids. I think we should. I think we should be more innovative in our thinking.
Really fascinating. Helen Greiner, co-founder of iRobot there. That's it for Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe. This is Bloomberg.